Hey guys, what's up? I'm Erin and welcome back to the channel. As far as returns are concerned, 2022 hasn't been great for investors. My personal favorite asset class, stocks, has been hit pretty hard. As of the time of this recording, the S&P 500, which is generally accepted as a barometer of the overall stock market, is down almost 14% from the start of the year. Interest rates from the Fed are still hovering around zero. High-yield savings accounts are currently earning less than a 1% rate of return, or rarely you can find those returning just a smidgen more than 1%, but those are even becoming more rare. And inflation is hovering around 8.5%. To have your purchasing power be eroded and take losses on your investments can feel like really big hits. You might be wondering, is there anywhere I can put my money right now to at least earn a decent return or maybe just keep pace with inflation? And the answer is yes, bonds. Specifically, government-issued I-bonds. I-bonds have two portions to their interest rate. They have a fixed portion which is locked in for the life of the bond, currently sitting at a whopping 0%. But they also have a variable rate, which is tied to the CPI, or the Consumer Price Index. The CPI looks at the average change in the cost to buy typical goods and services for consumers over time. When these items are becoming more expensive, we are experiencing inflation. The more quickly these items become more expensive, the more rapidly we're experiencing inflation. As the variable interest rate on I-bonds is tied to the CPI, as inflation increases, so too will the interest rates on these bonds. As of May 2022, the interest rates on I-bonds is locked in at 9.62%. I'm going to say that one more time for the people in the back, 9.62%. These bonds were designed to protect consumers against inflationary pressures, and that's exactly what they're doing. It's worth noting that the interest rate is stated as an annual rate, but the bonds do accrue interest on a monthly basis. It's important to note that the variable portion of the interest rate for I-bonds is actually set twice per year, in May and in November, and then it is locked in for those 6 months. You have no guarantees how that variable rate will change over time. It simply follows the CPI. If inflation worsens, it gets higher, the variable rate will increase. If inflation lessens, well, then that variable rate will go down over time. It is only locked in for 6 months at a time. But hey, it's a lot more than you're going to earn anywhere else right now. The good news is that these bonds can never lose value. The interest rate can and does change over time, but if you bought a $1,000 bond, it will always be worth at least $1,000. They are very safe, secure, and practically being our operative word there, no risk investments. Well, now that you know the government is willing to pay you an almost 10% rate of return, you've got to be thinking, there's got to be a catch. And in fact, there are a couple stipulations. First and foremost, you have to hold I-bonds for a minimum of 1 year. So that means if you purchase I-bonds, your money is locked up and completely untouchable for an entire year. So if you think you might need this money in the next 6 months, this is not a good place to store it. However, if you know you won't need this money for the near future, then you can absolutely securely store it in I-bonds. Also, if you cash your I-bonds within the first 5 years of ownership, you will face a small penalty. That penalty is the previous 3 months worth of interest. If you hold them for at least 5 years, you can cash them at any time without any penalty. I don't really worry too much about this penalty. After that 1 year mark has passed, I do look at this money as being pretty readily and easily accessible. Keep in mind that if you have a $1,000 bond earning a 9% rate of return, 3 months worth of interest would be about $22.50. I would be willing to forego those 3 months worth of interest if I decided I absolutely needed that money or found a better investment to make with it. The real time frame you have to keep in mind is that 1 year mark, as that money is completely inaccessible. There are limitations on the dollar amounts of I-bonds that you can purchase. The most direct answer is that you can purchase $10,000 worth of I-bonds per year, and the easiest way to do it is through the government's own website, treasurydirect.gov. Note that it is a little bit of a hassle to set up an account with this website, but it is a government-run website, so that's probably to be a little bit expected, and perhaps getting a 9.6% rate of return is worth jumping through a few hoops. Yes, you can find some of these bonds in secondary markets like on eBay, but don't buy them there. According to the government's own Treasury Direct website, what you end up buying in that instance is a piece of paper showing a bond that still is the property of the owner or the co-owners named on that bond, meaning you won't be able to cash them. So stay safe. Buy them directly through the government's website if you are interested in purchasing these bonds. For these bonds purchased directly through the government's website, it's important to note that you're not actually going to receive physical copies of the bonds in the mail. They're just held in electronic form. When you want to cash them, you just fill out the appropriate form on that same website, and then the government will give you the funds. You are able to purchase an additional $5,000 worth of I-bonds beyond that $10,000 in specific instances. If you are owed a federal tax refund, when you file your tax return, you simply have to fill out government form 8888 and the government will give you your tax refund in the form of I-bonds. The good news is that the interest earned on I-bonds is not subject to state or local taxes. They're also not subject to any inheritance tax, so they can be a good way to pass on some funds to your heirs. But they are, however, subject to federal income taxation. What about TIPS, or Treasury Inflation Protected Securities? TIPS are also issued directly by the US government. They're sold directly through that website, treasurydirect.gov. So they are similar to I-bonds with some key differences. TIPS and I-bonds are investment vehicles both intended to protect the consumer against inflation, as they're both attached to the Consumer Price Index. They are both subject to federal income taxation. I-bonds are only taxed when you cash them. However, TIPS are taxed annually as you accrue the interest. I-bonds are sold with a 30-year maturity date, and you have to hold them for at least a year. If you sell them within that first 5 years of ownership, you do face a penalty. However, TIPS are sold with different maturities. You can buy them with a 5, 10, or a 30-year maturity date, and they are sold in $100 increments. The good news is that there is a secondary market for TIPS, so you can resell them at any given time without any sort of penalty, even within that 1-year mark of ownership. The prices available at auctions vary. It could be more, it could be less, or it could be the same price that you bought your TIPS for. But that brings us to an important point. TIPS can decline in value if deflation occurs. They will always be worth at least their face value, what you purchased them for. But if deflation does occur, it can erode into the interest previously earned on your TIPS. That cannot happen with I-bonds. Once you earn interest for that month, that is locked in and it can never be taken away. TIPS interest rates vary more frequently. They adjust every single month in relation to the CPI, whereas I-bonds only adjust twice per year, in May and in November. And finally, the limits available for purchase are vastly different. When it comes to I-bonds, you can purchase $10,000 per year. When it comes to TIPS, you can purchase $5 million worth. At the end of the day, these are both wonderful options if you're attempting to protect yourself against those inflationary pressures. Which one is best? Well, it really depends on your personal circumstances and what your needs are. Let me know your thoughts down below. I post new videos every single week. If you got anything at all out of this one, please give it a like. If you're new here, please consider subscribing. Or if you know of someone who might get something out of this type of content, please consider sharing. I hope to see you guys soon. Have a good one. Bye.